It's time now for today's strategy session. With stocks hitting new highs following the election, what investment considerations need to be made going into a new administration? Joining us now is Jamie Battmer, who is the Creative Planning Chief Investment Officer here. Jamie, good to have you here with us this morning just after the opening bell. As you're thinking out to some of the themes that you think will be most prominent for investors in 2025 and after, of course, the changing of the guards in D.C., what most notably are you kind of aligning your portfolio strategy around?
Well, first, thanks, Brad, for thinking of us. Thanks for thinking of creative planning. Good morning. The real key consideration is not to let all the excitement, all the rhetoric, all the noise coming out of the election truly dictate investment decision-making. Because everything we do is driven by the historical empirical data and academic research. And all of it says is that the rhetoric is oftentimes the exact opposite of what occurs. We all talk about, the markets aren't red, they're not blue, they're green. But underneath the hood, people still say, this sector's going to benefit, the fact that there's a renewed Trump administration, or this sector's going to underperform because Harris lost. Well, historically speaking, the data just doesn't support that. You pull 100 people on the street, they say, is a Democratic or Republican administration going to be better for renewable energy? 100 out of 100 people say Democratic. Well, under Obama, and then Biden, it was down about 50%, and Trump, renewable energy was up about 300%. But I'm not here to say, look at Trump winning. The exact opposite can be held true of other sectors. Take big banks. You pull 100 people on the street, say, who's better, Democrats, Republicans? They'll all say Republicans. Well, big banks did nothing under Trump's first 4 years, and on average between Obama and Biden's time, they were up about 75%. So don't let the noise, the rhetoric drive things. Focus on what you can control. Some of those key end-of-year things and in broader diversification and asset allocation decisions.
Yeah, well, Jamie, talk to us a little bit more then about what you are telling investors to do right now between now and year end.
Yeah, again, those things you can control. You can't control what sectors are going to take off. You can't control who won the election, but you can absolutely control what you need to do. Rebalance. But you got to keep doing that. People think it's like a December exercise. No, that means all the volatility you think might only happen in December of the year. I mean, we only have to remember March of 2020 to realize how that's not true. Sorry for bringing that up again. But the idea, what can you control? Obviously, the tax loss harvesting, making sure, you're funding charitable accounts, funding those accounts that give you optimal returns. Like take a 401k or 403b if you have one, or your kids have one, or your grandkids have one. If you're not maxing it up to the match, you're essentially giving up a free 100% return and this beautiful tax benefit that comes with it. So if you're not maxing out before year end, and maybe you have some money on the sidelines, or you can help a family member out with giving them some money so they can readjust what they're contributing, that's what you have to focus on, because that just guarantees a more effective outcome instead of trying to crystal ball foretell the markets.
Jamie, of this earnings season, what's jumped out to you as one of the key themes that you've heard from companies that is really going to impact, at least more broadly, the thesis or the trade that's been prevalent to this point, which is around AI and where the shoes are going to start to drop for those companies that just blindly would say it on a call, but didn't really have anything to do with their business? Yeah,
I mean, there's always a hot dot to chase. I mean, sure, are we maybe in a tech boom or bubble now? Maybe. It wasn't that long ago we were in another tech boom that went bust, and the markets are just fine since then. They've been up hundreds of percent, but Cisco, the darling of that moment, is still down about 70%. So as long as you're not over-concentrated, you're unemotional, you'll be fine. Really what stands out to us is the continued reiteration of just how strong the underlying consumer is. Consumer driving 70% plus of the overall economy, and just how resilient they've been. And really, interest rates going up hadn't had the impact that maybe the Federal Reserve thought it would have, or what it had done traditionally. I think a lot of that is driven by just the changing dynamics of the underlying consumer. Baby boomers, this huge bump in the python as they get older and older, they're not impacted as much. More than 50% of them don't have any mortgage attached to their house. So they don't care that mortgage rates are going up. They actually like it because their money in their bank, the interest on their bonds are paying more. And so you're seeing that in restaurants being packed, airports being packed, cruise lines being packed. So really, actually, yes, AI is the hot down of the moment, but the underlying strength of you and I spending money as American consumers is the key, and that continues to be reiterated as surprisingly strong.